Did you know that only about 14% of Americans are actively investing in the stock market? But here is the mind-blowing truth. According to historical data, if you had invested just a few dollars a day into the S&P 500 consistently for 30 years, you could have potentially turned that into $1 million. Today, I'm going to break down exactly what the S&P 500 is, why it is such a powerful wealth building tool, and most importantly, the specific strategy that could help you reach that seven-figure goal. Because understanding this one fundamental piece of the investing world could be an absolute game changer for your financial future. What's up, everybody? I'm Rashida, your guide to smart money moves. I began my wealth building journey at the young age of 17. I have grown that portfolio to seven figures, and I did this all on a public servant salary. So I know that it's possible for you to get there too. I'm going to show you how to do that. So let's go. Look, I remember when I first discovered the potential of index investing with the S&P 500. I distinctly remember thinking that building wealth had to involve some sort of complicated strategy, some sort of insider knowledge, or already having a ton of money. And that little reality check, it changed everything about how I approached investing. And so here's why this matters so much. When you understand everything about how the S&P 500 works, you can use a surprisingly simple strategy that has helped countless ordinary people just like you and me build significant wealth over time. And so today I'm going to break down 5 key things that you absolutely need to know. What the S&P 500 actually is, no jargon, I promise. Why it's been such a powerful wealth building tool, the real risks that you need to understand, exactly how to start investing in it, and the big one, we're going to take a look at how much you need to invest monthly to potentially hit that $1 million mark. So let's start with what the S&P 500 actually is. All right, first things first, let's clear up some common misconceptions. You cannot actually buy the S&P 500 directly. And you may be asking, well, why? Because it is not a stock, it is an index. And so think of it like the ultimate fantasy sports league, but for the US stock market. This league tracks the performance of about 500 of America's largest, most influential publicly traded companies. And so we're talking about household names that we all know. We're talking about companies like Apple, Microsoft, Amazon, Google, the real heavyweights of the American economy. And so the S&P 500 is basically a list. It's a benchmark that follows how these 500 companies are really performing collectively. And now here's something super important that you guys need to understand. It is a market cap weighted index. And I know that sounds complicated, but the concept is super simple. And all it means is that the bigger companies get more weight in the index. And so let me break this down with real numbers. Apple makes up about 7% of the entire index, while a smaller company may represent only about 0.1%. That means when Apple's stock moves 1%, it affects the index roughly 70 times more than when that smaller company moves 1%. And so what that means is the giants heavily sway the average. And so why should you care about this? It's because these 500 companies represent 80% of the total value of the entire US stock market. And so that is absolutely massive. And so when you hear news anchors say that the market was up today, they're often referring to the S&P 500. And so now let's take a look at what the performance of this index has been throughout history. But before we do, please take a second, see if you have subscribed to the channel. And if you haven't, consider hitting that subscribe button, hit the notification bell so you don't have to miss out on any of my future content. I come here every single week to help you better understand the world of money, and more importantly, give you tips and strategies on how you can turn your income into real wealth. Now, the S&P 500 wasn't created yesterday in some Silicon Valley startup, okay? This index has serious history going all the way back to 1923, but the S&P 500 as we know it actually launched in 1957. And so that is over 65 years of data. Think about everything that's happened since then. Economic booms, major recessions, the Cold War, the tech bubble, 9/11, the 2008 financial crisis, the pandemic. And so the S&P 500 has tracked America's largest companies through all of that. This long history matters because it's giving us information on how the market has performed through countless economic cycles. And the performance, well, this is where things get really interesting. And so if we take a look all the way back to 1957, the S&P 500, including reinvested dividends, dividends has delivered an annual average return of right around 10%. And so let me emphasize that word, average, all right? It's definitely not 10% every single year, okay? Some years it's going to be up 20% or more, and other years it could be down 20% or worse. During the 2008 financial crisis, it dropped almost 38% in a single year. But over the long haul, over decades, the average comes out to roughly 10%. And so here's where the magic happens. When you combine that kind of average return with consistent investing over many years, that compounding effect is absolutely transformative when we are talking about building wealth. And so now that you understand what the S&P 500 actually is and its impressive track record, let's break down exactly why investing in it is such a popular strategy. Here are the 4 biggest benefits. First up is instant diversification. And so instead of trying to research and pick individual stocks yourself, when you invest in an S&P 500 fund, you immediately own a small piece of 500 different companies across various industries. And so think about it. If you put all of your money into just 1 or 2 companies and they struggle, your whole investment could tank. But with 500 companies, if some of those perform poorly, the others are likely to be doing well, which will balance things out. And so that is the power of diversification. And second is going to be historical performance. Now, we've already touched on this, but it bears repeating. The long-term average of around 10% is nothing to sneeze at, guys, because that kind of consistent growth over decades is exactly how regular people can build significant wealth. Now, the third thing is going to be simplicity and low cost. Investing in the S&P 500, it doesn't require complicated strategies or hiring an expensive financial advisor. You can do this yourself very easily through index funds or ETFs, which we'll talk about in a minute. And so here is going to be a huge advantage for you because these type of funds typically have very low fees, often between 0.03 and 0.1% per year. A 1% difference in fees could literally cost you hundreds of thousands of dollars over 30 years. Now, the fourth thing is going to be the proven track record. The S&P 500 strategy isn't some trendy new investment fad. It is backed by decades of real data. This is all about owning a piece of America's most established and successful companies. And this simple strategy is endorsed by legendary investors like Warren Buffett, who has repeatedly recommended the S&P 500 index for most investors. So you have diversification, strong historical returns, simplicity, low cost. All of this sounds incredible, right? But I wouldn't be doing my job if I did not give you the full picture. So let's take a second to talk about some of the risks so that you understand them. And so in reality, investing always involves risk, and the S&P 500 is no exception. And so here are 4 of the biggest potential downsides that you need to know about. The first and most important is going to be market risk. The S&P 500 is the large cap US market. So when the market crashes, which it does periodically, your S&P investment is going down with it. And so there is no hiding from this reality. They will include periods of significant losses. During the 2008 financial crisis, the S&P dropped nearly 40%. In March of 2020, when the pandemic hit, the S&P 500 index fell 34% in just 1 month. And so you will need emotional discipline to ride out any downturns without panicking and selling at the bottom. This is crucial to understand. Downside is the price you are going to pay to get those phenomenal returns over the long time. And this is where most investors are going to mess up. They are going to sell when things look scary, locking in their losses, and they're going to miss the recovery. It is so important to stay invested for the long term if you're going to do this. The second biggest risk is going to be concentration risk. And so remember when we said this is a market cap weighted index? Currently, just 10 companies make up about 30% of the entire index. And so that means if those specific mega companies, mostly these giant tech companies, if they struggle, they are going to drag down that entire index, and it may be more than you expect. And the third risk is going to be limited scope, because since the S&P 500 gives you exposure to a lot of the large US companies, you're actually missing out on some of these smaller US companies that may grow faster. You're missing out on international markets. You're missing out on other asset classes like bonds or real estate. And so relying only on the S&P 500 means that your portfolio overall isn't truly globally diversified. And the fourth risk, although it may not seem obvious to most people, is that there are no guarantees, because that historical 10% average return, it is just that, it's history. And so it's very important to understand that past performance does not guarantee future results, because the market conditions of the past may not repeat. Future returns could be higher, they could be lower, they could be flat. There's no way to know, because no one has a crystal ball to know what the future holds for the United States. And so anyone that is promising you guaranteed returns in the future is full of crap. They are lying to you because they don't know what the future holds, and their name is probably Bernie Madoff Jr. or something like that. So don't listen to these people. Now, so with all the facts being laid out there, let's move on to how you can actually start investing. Okay, so now you understand what the S&P 500 is. You appreciate the benefits. You're now aware of all the risks. And so if you're still thinking, I want in, let's go, we're going to discuss exactly how to do that. Okay, so first, remember, you don't buy the S&P 500 index directly. Instead, what you're doing is you're investing in a fund that is specifically designed to track the performance of the S&P 500. And so what these funds are doing is they're holding all of those 500 companies in the right proportions for you. And so there are two main types of funds that you'll encounter. The S&P 500 index funds are mutual funds. And so they are traditional investment funds that you typically buy directly from companies like Fidelity, Charles Schwab, Vanguard. And some of these companies do have minimum investment amounts. It could be $1,000, $3,000 to start, but many of them now offer lower minimums. So it just depends on who you choose. The price that you pay is set once per day after the market closes. And so this is something that is specific to mutual funds. Now, your second option to invest in the S&P 500 is going to be exchange traded funds, or what they are more commonly called ETFs. Now, these trade on stock exchanges just like individual stocks. And so what that does, it just allows you to buy and sell them throughout the trading day. And so a huge advantage to ETFs is that they have no minimum investments. So you can buy one share or even a fractional share through mini brokers. And so some of the more popular options include funds with the ticker symbol VOO, SPY, or IVV. And so the actual process to start investing is surprisingly simple. Step one is opening a brokerage account. You'll need to open an investment account with a brokerage firm. Now, there are many online brokers that make this process super quick and easy. Now, I've partnered with money.com so that you can take advantage of some of these sign-up offers that these brokers are offering. Money.com has done tons of research, and they've actually compiled a list of the best brokers in the business. So do me a favor, check out the link in the description and get yourself set up. Now, step number two is going to be to go and fund that account. It's really simple. All you're going to do is transfer money from your bank account to your new brokerage account, okay? They make it quick and easy, all done online. It takes a couple days to get that brokerage account fully funded. Now, step three, once the money is in your new account, you want to do a search for S&P 500 index funds or ETFs. It's going to be really easy for you to do, okay? And then once you do that, you're going to pick the one that you want by clicking on a ticker symbol or a name, and then you're just going to place your order to buy. And so whatever you do, when you are choosing a fund, make sure you pay close attention to the expense ratio. And that's just a fancy way of saying the annual fee to hold this investment. And so you're going to look for funds with an expense ratio of less than 0.1%. And some of the best funds around are going to have an expense ratio of 0.03%. And all that means is that for every $10,000 you have invested in that fund, they're going to charge you $3 in annual fees. And that is great. You cannot beat that. Now, we've already established that the S&P 500 has historically delivered average returns 10% over the long term, right? And so the $1 million question is literally, how much do you need to invest every single month consistently for 30 years, assuming you achieve the average annual return of 10% to potentially get that $1 million portfolio value? And so now I all want you to take a guess as to what that number is. And so put that number in the comment section below. What's your guess? Is it $2,000 a month, $1,000 a month, $500 a month? Now, based on the math and understanding compound interest, which is how your money earns money, and then that money earns money, and it just builds and snowballs on itself to potentially reach $1 million in 30 years with an average 10% return. You would need to invest about $442 per month. Let me say that again, roughly $442 a month. That is $15 a day, you guys. And for most people, that is a daily coffee and a lunch habit. It's a car payment. It is cutting back on a few subscriptions. It's dining out a little bit less. The point is, it's achievable for many middle income Americans. And to illustrate the incredible power of what compound interest has done here, you need to understand that if you do that $442 a month for 30 years, you have only invested $160,000 of your own money, and you ended up with $1 million at the end. Do you understand how powerful that is? And so when people tell you that you're in the middle class, you're stuck there, you will never be a millionaire, you have the math to prove them wrong. And so remember, this assumes a 10% annual return per year. In reality, these returns are going to fluctuate from year to year, and it doesn't account for taxes you owe after those investment gains, all right? It doesn't account for inflation, which reduces your purchasing power over time. But where I'm from, $1 million is still $1 million. And again, past performance doesn't guarantee future returns. But even with all of the caveats, what this calculation powerfully illustrates is the potential impact of starting early, investing consistently, and harnessing the power of compound growth over decades. And so this goal is in reach for many people out there. All right, guys, so there you have it, the S&P 500 index demystified. Hopefully you understand that a lot better. If you are still here at this point in the video, drop a 500 down in that comment section. I really appreciate you guys being here. Don't forget, check out that link below in the description, and do me a big favor. If you found this video helpful, share it with 3 friends. I will see you guys in the next one. Again, I'm Rashida, and I'm